Hello and welcome. I'm Vijay Srinivas, and this is the Federal Special Exclusive Interview with IDFC Chief Economist Gaura Sengupta. She's joining us to talk about the inflation number that has just dropped to 2.1%, significantly low in the last 6 years. Thank you very much for your time. Does this low inflation reading, reflect a sustainable trend as far as inflation is concerned, or you see this as some kind of a one-off scenario?
This is a sustainable trend. There has been a sharp decline in food inflation, which has been broad-based, spread across volatile items such as vegetable, pulses, and cereals.
Hmm.
It's a reflection of the fact that last year monsoon was good. We've had a very strong kharif as well as rabi crop output. This year monsoon, while still progressing, it's been a good pickup. So it's I would say a very, at least within the food basket, it's a very broad-based pickup. There's also the fact that core inflation, which is basically you remove food and fuel, there is some pickup there, but that is more a base effect story rather than actual demand pressures.
That's exactly where I'm coming. I know that you think this is the disinflation, or is this disinflation real, or you see simply because of the tweak in the base effect, a kind of a favorable statistical base.
Not base effect because the month-on-month increase that we are seeing in food, it is softer than the usual seasonal pattern, and we are seeing this in cereals, we are seeing this in pulses, we are seeing this in vegetables. So it's not base effect. It's the fact that we are getting better food supply because the monsoon performance has been better. On the core front, what we are seeing is the month-on-month momentum is along the usual seasonal patterns. There's a little bit of adverse base and surge in gold prices, which is the reason why core is looking a bit elevated. But if you remove core, then core, which is basically core excluding gold prices, fuel prices, etc., that's very benign. It's averaging at around 3.4, 3.6%, or 3.5% for the last 6 months, which is indicating the fact that the economy is not growing at potential, it is growing below potential.
Okay, how do you see the impact of inflation, the CPI print on the Reserve Bank of India's monetary policy meeting that's going to come in next month, the first week of August? In the last meeting, we had seen a change in stance to accommodative to neutral. So but I also listening to this interview with CNBC TV 18 where the RBI governor had said. Neutral doesn't mean that there are no rate cuts anymore. So I think clearly he's hinting at there could be a possibility. How do you assess these conditions?
We always had a base case that the terminal repo rate will be around 525.
Mhm.
Even we maintained that before the June policy, we maintained it post the June policy. And the space to reach 525 was derived from the fact that inflation was looking softer because mainly because of food, but it was also a factor that you have excess capacity, which is getting reflected by the fact that core is still, I would say, core inflation is still very benign. So the space to cut rates is derived from the fact that inflation is significantly undershooting the target. RBI target is 4%, their estimate is 3.7. Our inflation estimate for the year is tracking at 2.7. So there is a quite a significant divergence in the forward-looking trajectory between what RBI is estimated and where we are seeing. And that is where we see the space for one more rate cut. The neutral stance, as the governor said, does not remove or take off rate cuts from the table. It just makes the policy much more balanced, where it has equal probability for a rate cut, equal probability for a pause, equal probability for a hike. But it does not remove the possibility of rate cut. So I think the stance change that took place in the month of June was more a communication tool because he cut policy rates by 50.
Mhm.
So he front loaded. Usually you have a 25 basis point cut. So he wanted to communicate to the market that they're nearing towards the rate cut cycle, the end of the rate cut cycle, which is also what we expect. So we just expect one more rate cut. So the neutral stance does not prevent that in any shape or form. And even the governor today stated that if there is a deviation in growth, if growth is lower than what they're estimating, or if inflation is lower than estimating, then there is a space to cut rates.
Okay, so and I want to focus a little bit on consumption there. What does this inflation reading mean for rural and for urban consumption? Consumption remains tepid. Because we expected that it could actually certainly pivot after the direct tax cuts the finance minister had pushed for during the union budget. There, FDI investments haven't been coming. Private investments haven't been coming in either. What's your take on that aspect?
So I would say what we are seeing on the growth data is it's not there is not a massive amount of weakness. There is a moderation, and it compared to other countries, we are on a much stronger footing. We are operating in a very difficult environment where export growth is getting affected by the tariff tensions. But it is, I would say, a softening pace. For example, the weakness in growth that are seeing is on urban consumption because urban wage growth had slowed since FY25. It's
Hmm.
getting reflected in the consumption. The other thing is that there was a big savings buffer which households had generated or saved up during the lockdowns, which helped us for the next couple of years. It's now got used up. Household savings rate is now below what it was pre COVID. So the real impact of slowdown wage growth is getting visible. The other place of weakness is the fact that private corporate capex is a bit tentative, which
That's true.
is, I would say, expected given the fact that there's so much uncertainty on the external front. There's also no clear signs of when will the urban demand revive. So companies are cautious, but there are supports to growth. You've got very uh, good prospects for rural consumption. We are already seeing a pickup since the March quarter in rural FMCG sales growth. Rural wage growth is beginning to pick up. The fact that Kharif and Rabi sowing is going to be better, that is also going to be supportive of rural demand. And the other support is going to come via the government in form of better pickup in capital expenditure, both at
That's
the
right.
center and state level. And you're actually seeing that Q1 FY26, there was a very strong pickup in capital expenditure in center as well as state governments. So that those are the two supports that are coming in. So net we're not very negative on growth. We still expect a 6.3% GDP growth in FY26, which is broadly in line with what RBI is expecting. But it's not, I would say there is some moderation. Last year we grew at 6.5. This year we are expecting slight moderation. So there is a slight moderation and there is policy space to support growth.
But are we entering? Are we in danger of entering into a low inflation zone with sluggish growth there? Understand, growth is resilient. We keep hearing this, but is this the kind of scenario are we entering into?
Not really, because we do expect inflation to pick up next year. The reason why
Mhm.
we are saying, for example, if you have an inflation expectation of 2.8 or 2.7 for the year, why only one rate cut? The reason why we are saying one rate cut only is because FY27 is expected to be a bit towards 4%. In it automatically gets pushed to the 4%. A large part is base effect, but we don't see an issue like, for example, what you saw in countries. That's a very extreme stretch. Like, let's say what happened in Japan, where they got stuck in decades of deflation. What we are seeing a moderation in pace of inflation, which is more commodity led. The core inflation is gradually picking up, but it's gradual because we have the capacity to grow higher. We are growing a bit lower, so there is capacity, excess capacity in the economy. But I don't see this as a indication that this is a sort of a persistent disinflation. The way our inflation is really constructed, 50% is food. So 50% is determined by supply side factors, food
Mhm.
supply basically. A very small proportion or the remainder is due to demand side factors, which is basically what your 50% is food, then you've got a bit which is fuel and light, which is again supply side, then you've got core. Core is the real demand part of the basket. So this disinflation is currently being led by food. So I wouldn't see it as a warning sign, but
Mhm.
when you look at core, it is telling you that the urban side of the recovery is softer.
Okay. Thank you very much, ma'am. Always a pleasure talking to you. Thank you.